Well, good afternoon, everyone, and welcome to the 2023 Mortgage and Housing Summit. My name is Mike Fratantoni. I'm the Chief Economist and Senior Vice President of Research and Industry Technology at the Mortgage Bankers Association. And today's event is a joint effort between the Mortgage Bankers Association and our partners at Mayer Brown. So really appreciate the opportunity to be a part of this conversation. We have a very full agenda, lots of rich content, and want to jump right in. So as I mentioned, my role here as chief economist, keeping track of market developments. So we thought it could make sense to kick things off. I'll just give a quick overview of how we're looking at the market. So let me bring up a few slides to do that. And then I will hand things over to the folks at Mayer Brown. So always an interesting time to be forecasting and talking about market developments, but this week particularly so, looking for what could be a very interesting FOMC announcement later this week. Our expectation, along with many others, is that they're not going to change rates this week. But I think more people are looking for any indications they're giving as to whether they are now at the peak for that rate cycle, which is, as we're showing here, is our forecast, whether they might hike rates one more time, perhaps in November. We are seeing inflation begin to reduce, so that's a positive. At the same time, the hopes that they might be able to engineer a soft landing, so inflation coming down without putting the U.S. economy into a recession, certainly seems like a better chance of that than we would have thought earlier this year. That said, again, we think they're going to hold rates at the current level between 5.25 and 5.5, and we'll begin to see them cut rates after we get through the first quarter of 2024, and probably cut rates by about 100 basis points next year. In the meantime, the industry is struggling through particularly high mortgage rates right now, calling about 7.25% for a 30-year mortgage rate. Again, if we're right on the call for the Fed to begin cutting rates next year, longer-term rates should begin to drift down after we get through this period of uncertainty, and that is our expectation. Higher mortgage rates absolutely has led to a sharp drop in refinance activity. The other challenge that the industry is really struggling with, though, is a lack of inventory. And shown here, particularly with respect to the market for existing homes, typically we'd expect 2.5 to 3 million homes to be listed at any time. We're at about 1 million. That's about 3 months of supply at the current pace. So it's a real struggle for potential buyers to find properties. The only real beneficiary of this kind of a market have been home builders and mortgage lenders who are affiliated with those home builders, because where typically we would see maybe 5 to 10% of properties on the market as new construction, because there's so little existing homes, about a third, more than 30% of homes currently listed are new construction. So builders are able to sell whatever they're able to put up and quickly and not at much of a price discount. And that lack of inventory has enabled home prices to hold up really much, much better than many had forecast earlier this year, late last year. So if you remember, during the pandemic, we were seeing home prices increase well into the double digits, almost at a 20% annual rate. That has cooled down given the more than doubling of mortgage rates. But you see, our current forecast would have national home prices essentially flat this year, and then beginning to increase again next year, again, contingent upon that forecast of mortgage rates drifting down somewhat. So not as quick appreciation as we've seen in the past, but certainly not the dire predictions that some had of a deep drop in home prices, reminiscent of what we saw in 2008. This is just a very different market given this extreme lack of inventory. But the challenges of low inventory on the purchase side and high rates really curtailing refinances has led to, again, a very challenging picture for mortgage originators. If you go to 2021, we had an all-time record, $4.4 trillion of volume. That dropped about in half in 2022 to $2.3 trillion, and our current forecast has that dropping another quarter or so to about 1.7 trillion in 23. We do think 24 and 25 will be stronger years as some additional inventory begins to come onto the market. Some of that lock-in effect of low rates begins to fade if rates drift down. And just people, while they can put off moves for some time, sometimes there really are family, demographic, job reasons why they need to move, and that'll pick up pace over time. So expecting a market north of 2 trillion the next 2 years. But just thinking about how this has impacted mortgage lenders, the pandemic refi boom was just phenomenal, both in terms of that record volume and the profitability. So I'm showing here net production income in basis points. So if you go back to 2008, your typical mortgage lender, and this is a sample of about 300 IMBs, had a profit of about 50 basis points per loan, about $1,000 per loan. That profitability was 4 times higher in the end of 2020, just given how much volume was being pumped through a capacity-constrained industry. But it has fallen off quickly since then, and the level of volume we're seeing now, and many lenders really bumping up against some real fixed costs in their business. The last 5 quarters, we've seen your typical lender losing money on their origination, many of them still being able to be all-in profitable because it's a servicing business, but a very, very tough business environment for mortgage originators. Last slide before I turn it over to Anna. I mentioned one piece of good news is just the ability of home builders to thrive in this market given the lack of existing inventory. The other piece of good news is the combination of an unemployment rate, which is still quite low at about 3.8%, and the fact that home prices haven't dropped in a housing market which anybody that needs to sell can sell and sell quickly. We have delinquency rates at the lowest level they've ever been. So as of second quarter of 2023, the all-in delinquency rate is the lowest we've seen going back to 1979, where we've been doing this quarterly survey consistently since then. So while we do expect the economy is likely to slow from here and the unemployment rate is likely to rise, we're starting from a phenomenally strong point with respect to mortgage performance. So Anna, let me stop there, turn it over to you. And I don't know if you wanted to go ahead and introduce your team, and we'll kick off on the meat of this conversation.
Sure. Thanks so much, Mike. There are going to be a number of us, so we'll introduce ourselves as we go through today's presentation. I'm going to just go through a little bit of boring lawyer stuff. So for those of you who are joining us today and would like CLE credit, during the course of the presentation, we'll announce a CLE code. We'll probably announce 1 or 2 CLE codes throughout the course of today's program. There are CLE forms that we circulated together with the connection details. So if you'd be kind enough to complete those and return those to the Mayor Brown email address that's listed on the CLE form with the affirmation form, then we'll take care of returning that with the CLE credit certificate. Today, in order to make this interactive, just use your Q&A tab or the chat function there to ask questions, and we'll try and answer the questions as we go through the presentation. We want to make this as interactive as possible. And we will send the slide deck as well as some of the supplemental materials at the end of today's presentation to everyone who registered. And as I mentioned, we're going through a fair bit of material. We're delighted to have you join us and very pleased to be partnering with the Mortgage Bankers Association. So Brian Hirschberg and I are both partners in the Capital Markets Group. We both sit in New York. We'll go to the next slide. And just to introduce the topic, and I'm sure those of you who are joining us are familiar with the dynamics in the capital markets for mortgage REITs and for mortgage companies. It's been a relatively quiet last half of 2022 and a quiet 2023 thus far in the capital markets, relatively few follow-ons. And it seems like the follow-on is nearly extinct. A lot of the equity activity is taking place through at the market offering dribble out programs, which has an interesting effect in the sense that it does allow at least mortgage REITs to access the capital markets, raise capital in little bits. And while the sector continues to trade at a discount to stated book, at least with ATM activity, the mortgage REITs can at least time their issuances a little bit. As Brian will talk about, we've seen a fair number of M&A announcements in at least the mortgage REIT sector, but also with independent mortgage brokers and within the specialty mortgage sector as well. At least for mortgage REITs, M&A is indirectly, as we note on the slide, providing some non-dilutive growth. There haven't been any IPOs since Angel Oak back in June of 2021. However, including with some of the M&A announcements, we are seeing an interest in going public. Some of that is taking place with private REITs attempting to merge with existing public vehicles. And we're also seeing it with private REITs also attempting to engage in de-SPAC transactions. So if you thought that you had seen the end of the SPAC market, maybe there's a little life left in de-SPACs in the REIT sector as a way of going public. And a lot of that is just trying to monetize the value of a public platform. We're also getting questions and have been getting questions now for the last few months on REIT formation. So all of that is interesting. We'll go to the next slide and we'll talk a little bit about some of the case studies in terms of the M&A activity, and Brian will do that.
Yep, thanks, Anna. So as was mentioned, we've seen a lot of consolidation in the mortgage REIT space over the last few months, and that has raised some particular interesting legal considerations relating to mortgage REIT M&A. So transactions can be structured in a number of different ways. The manager, for many mortgage REITs, they have an external manager structure. And so the transaction can be structured for the acquirer to buy out the manager entity directly, assuming the manager doesn't have any other significant assets or other management contracts outside of that REIT. In this structure, the directors of the mortgage REIT will generally still be required to approve the assignment of the manager's contract. However, more commonly, and what we've seen over the summer, is that the management contract is just terminated outright, and the mortgage REIT is acquired directly. The termination of that contract will inherently trigger a termination fee, 2-3x termination fee. And it's important to understand how the calculation of that termination fee relates to the unrealized losses that very well may be at the REIT level itself. Also important to understand, if the acquirer mortgage REIT is also externally managed, will the external manager of that acquirer be contributing to the transaction? Will they be paying the termination fee or a portion of it? Likely that manager of the acquiring mortgage REIT will be seeing a significant increase in their management fee as a result of the transaction. So very often there's an incentive to contribute to the transaction's price. In terms of process, because many mortgage REITs are externally managed, you have directors that are affiliated with the external manager on the board of the mortgage REIT. So we see mortgage REITs form special committees that are comprised entirely of independent directors in order to review and consider, M&A proposals. That committee will separately then engage financial and legal advisors to also help with that review. Important in the residential space, especially to consider change of control type approvals. State, federal agencies very well may require approval. This will require several month lag time to the extent that there's a servicing business that's being acquired. There might be licensing, change of control reviews that need to be done in connection with that. But as a result, the target REIT during the course of that that M&A review is going to have to remain in good financial health. So it's important to understand what are the negative operating covenants that are being agreed to in order to maintain that good financial health. Will, cost-cutting measures, as Anna mentioned, ATM issuances are frequently being done. Are those contemplated as far as the whole M&A structure in order to kind of keep that good health and that good financial activity at the target mortgage REIT alive? Final bullet there relates to diligence. What is the plan for the target REIT's outstanding securities? It's very well may have outstanding preferred securities, debt securities, warrants. Are they coming over as part of the acquisition, or are they being taken out as a condition to finalizing the transaction? Price discovery, we've also found, has been relatively extensive as part of the diligence process. In this environment, valuing different mortgage assets can be very time consuming. So that has often taken a great amount of attention and time in order to discover the right price for mortgage assets. The next several slides really just describe the transactions we've seen in the market. As Anna said, we'll circulate the slides and you can peruse those details. So skipping ahead to the share repurchase disclosure rules. So in May, the SEC adopted new buyback disclosure requirements. So these amendments require both quantitative and qualitative disclosure of buybacks on a day-by-day basis. They also revise and expand the existing periodic reporting disclosures for buybacks. So the long and the short of it for public reporting mortgage REITs that have a calendar year end, for their fourth quarter, they're going to have to include buyback disclosures in their 10K that gets filed next year. Next slide. So the amendments in particular, they require a new tabular disclosure for those daily buybacks, which will need to cover the date of the repurchase, the total number of shares, and the average price paid per share. For the programs itself, the disclosure will need to include the aggregate maximum number, or if the dollar value is used, then the dollar value of the shares that may still be purchased, the number of shares that have been purchased pursuant to the 10b-18 safe harbor, and then separately the number of shares that are intended to satisfy the 10b-5-1 affirmative defense. Question we often receive here is relating to these amendments is whether there's a materiality or there's a de minimis threshold here. The short answer is no. These will cover the repurchase of just one share. So no de minimis threshold here. Next slide. So separate from that repurchase table, there's going to be narrative disclosures that are required. Issuers are going to have to describe their share repurchase objectives. What are their rationales for adopting a share repurchase program? What's the criteria or the process that the issuer uses to determine the amount, the size of the repurchases? What are the policies and procedures that are adopted relating to any director and officer purchases and sales during a repurchase program? What are the restrictions on the buybacks? Those will have to also be disclosed. So details regarding purchases, such as are they being consummated through open market transactions or otherwise? So lots of disclosure here. Next slide. So as a result, companies should, if they haven't already, begin preparing disclosure controls to implement these new requirements. So you need to have a plan in place to, gather the relevant information from the broker that's being used in order to present that in that tabular format that I had mentioned to capture that on a daily basis. Companies will have to consider how much detail that they choose to include in their filings, given the various audiences that will be taking a look at it. Think investors, think, research analysts, lots to consider in terms of that and the strategies and alternatives that are being employed by that company. Next slide. So potential things to consider here, very likely there may be more reluctance to adopt 10b-18 buyback programs. Not mentioned here, but the amendments to 10b-5-1 that came out earlier this year also will likely have more eyeballs on this type of disclosure, these type of activities, more scrutiny, whether warranted or not. And so companies should begin to plan for these disclosures and how they're going to document their objectives, rationales, and processes now. Next slide. So also, there's a new clawback policy requirement that hasn't gone into effect yet, but companies will be required to have in place their new clawback policy by December 1st, and they will be filing that publicly with their 10K next year. Next slide. Mortgage REITs will need to really need to evaluate which individuals should be treated as subject to the clawback policy. There are certain non-negotiables. The principal accounting officer, financial and executive officer are all going to be covered. However, there are other individuals who may be deemed executive officers if they have as listed here, a policy-making function for the mortgage REIT. Then they also may be considered covered by the new policy. Next slide. The rules cover both big R and little r restatements. Both are within the scope of the recovery policy. The rules define incentive-based compensation to include any comp that is granted upon the attainment of a financial reporting measure. Financial reporting measures include stock price thresholds. They include total shareholder returns. So, items that are frequently used. Listed companies are required, no discretion here, to recover that amount of incentive-based compensation, with the only real discretion being in terms of timing. The rule requires them to use a reasonably prompt effort in order to make that recovery. Last note here, companies are prohibited from indemnifying the executive officers for any incentive comp that is recoverable pursuant to a clawback policy. Last slide here before I turn it back over to Anna addresses, the external manager structure. As I said out front, many mortgage REITs are externally managed. And so how does that relate to the new clawback policy requirement? And this again is why, it's worthwhile to make sure that, you spend the time understanding which executive officers fall under that umbrella. External managers receive incentive comp pursuant to the management contract, and many employees of the manager will also receive equity grants from the manager. The employees and the manager are, generally speaking, outside of the scope of that policy-making function individual that would be subject. So that executive comp, we would anticipate is outside of the scope of the new clawback policy requirement. Now, notwithstanding that, many management contracts have separate clawback features that may not be related to a financial statement restatement, but are related to other performance, factors. But we think that is outside the scope here. So with that, I will pass back over to Anna to cover cyber incident disclosures.
Okay, so in July, the SEC adopted final rules that are aimed, according to the SEC, it's standardizing and enhancing disclosures relating to cyber incidents. So most public companies already provide pretty significant risk factor disclosure, as well as disclosure in their business sections regarding cybersecurity. What the SEC was objecting to or reacting to in this instance is that not all companies provide the disclosure in the same places. So companies don't consistently disclose in risk factors or in business versus MD&A. The SEC contends that companies don't necessarily promptly or sufficiently promptly disclose when cyber incidents or cyber breaches occur. So these final rules are supposed to make disclosures more consistent and make it easier for investors to identify and compare disclosures across public companies. There's an incredibly short effective date. So the final rules have already become effective. You see the effective dates in the slide. They become effective for this new 10K season. And with the final rules, the SEC did take into account a lot of the comments, and the comments effectively resulted in the SEC narrowing the scope of disclosure. So we have some tables on the next couple of pages. They narrowed the scope of disclosure. They added a limited delay for disclosures that pose a substantial risk to national security or public safety. In essence, that's rarely going to get used. They require updated incident disclosure on an amended Form 8K instead of requiring it on a 10K or in a queue. They omitted the concept of aggregating insignificant individual cyber breaches and looking at a materiality analysis on an aggregate basis. And the SEC pared back its original proposal, which would have peered into the boardroom and required some fairly invasive discussion of skills and assessments of cyber preparedness in company boardrooms. Nonetheless, companies now have to disclose cyber incidents once they've determined that they've experienced a material cyber incident within 4 days of having made that materiality assessment. The materiality assessment or the materiality standard doesn't change. Subsequently, if there's a change, then that gets reported on an amendment to that Form 8K. And if you go to the next slide, you'll see the changes to Form SK. And these are the changes that relate to the periodic reports, the Q and the K. And these are more process-driven disclosures. This relates to the process that the board undertakes relating to oversight of cyber-related risks. So again, here, companies will have to prepare early and undertake with some rigor a process for identifying the types of disclosure controls and procedures in advance of the reporting season, this reporting season, that will permit the company to prepare the disclosures necessary for risk factors for business, and also get at the information that they'll need for D&O questionnaires. So that's a quick rundown of a fair number of pretty substantial SEC rulemakings. With that, I'm going to turn it over to our bank regulatory partner in Washington, D.C., Matt Bizantz, to talk about the Basel Endgame. So Matt.
Thank you very much, Anna. And we're going to cover the high points of this for the mortgage industry, bearing in mind that this is an 1,100-page proposal that affects nearly every credit granting, trading, or operational aspect of these larger banking organizations. And so we are covering just a small snippet. And while I realize it's very important to those on this call, arguably not even the most significant pieces of the rule, because the thing to remember is that this proposal is not targeted at the mortgage industry. It's not even targeted really at credit granting activities. That the focus of this was around trading and around variability in things like banks' equity positions. And so to the extent we touch on these mortgage items, they are almost the collateral damage from the larger proposal. So the scope of the proposal is U.S. banks with 100 billion or more in total assets. That's about the 35 to 40 largest U.S. banks and U.S. Holding companies of foreign banks. And then with respect to market risk, which is regarding trading activities, there's about another dozen U.S. banks that are picked up because they're smaller than $100 billion, but they still have significant trading activities. The proposal doesn't apply to foreign banks, to U.S. branches of foreign banks, to non-banks like mortgage companies that are, unless they're owned by a bank. So it has a fairly limited scope. And on this next slide here, we've included the banking organizations who we believe are subject to one or more parts of the proposal. So as you can see, it's a fairly small number of banks, but they are mostly well-known banks that almost all of us have heard about. Now, for credit risk weights, the biggest change, or the change that's been getting the most headlines, is that they are making the risk weights for residential mortgages more granular. And the way this works is banks are required to hold capital versus their assets. And for a bank, its biggest assets tend to be its loans. But all loans aren't created equal. That a loan to the U.S. government is, all things being equal, less risky than, say, a subprime loan to a borrower, or a loan that maybe is defaulted. And so all loans on a bank's balance sheet are assigned risk weights, and that is a factor that is used to adjust the carrying value of the loan so that the bank can aggregate all of its loan exposures and then put that versus its capital to determine its capital ratios. Right now, the categories for residential real estate mortgages are fairly limited. That you have FHA, at 20%, recognizing there's a fairly low risk associated with a government guaranteed mortgage. Then you have 50% for a qualifying first lien residential mortgage. That's something that complies with the appraisal guidelines, with the real estate lending guidelines. There is a statutory carve out for certain multifamily mortgages that is of interest to both the resi and CRE markets. And then all other residential real estate goes in the 100% bucket, meaning that you hold capital against the entire value of the loan. Typically, that's 8% capital, so 8 cents on the dollar of capital versus every dollar of mortgage. Under the proposal, it would be far more granular. You can see here that now we have a dozen new categories covering a whole range of LTVs, and also covering whether it's cash flow dependent or not cash flow dependent. And I like to think of it as not cash flow dependent is owner occupied, cash flow dependent is rental. And so this new granular set of risk weights will apply to all residential real estate loans, even those that are currently on a bank's balance sheet. And while the numbers generally look good, like in most cases, the owner-occupied are around 50%, and the non-owner-occupied are still mostly less than 100%. all of these percentages are about 20% higher than what they are in Europe. And so in Europe, the LTV scale starts at 20% and goes up to 105 instead of the US proposal, which is 40 to 125. And this is something that we're expecting to see a lot of comments on. The other bucket, obviously, of interest is commercial real estate, because it historically also had the same granular 50 or 150%. And going forward, it will also have the more granular, depending on the LTV and owner-occupied versus rental. We think one issue that will get a fair bit of comment, or two issues that will get a fair bit of comment around them from this slide. First is the 110% LTV, 110% risk weight for a high LTV rental property. And the reason is that if you made an unsecured loan to a borrower, its risk weight would typically max out at 100%. But by categorizing it as commercial real estate as a high LTV loan, where you still have security, it comes in at a worse 110%. And I think that to me is not an intuitive outcome. The other piece here is that other commercial gets a terribly punitive 150% risk weight, the same as a defaulted exposure. And this is a broad category that actually picks up things like mezz lending, property where there isn't a direct security taken in the real estate. And so we think this other commercial bucket will also get a fair bit of comment because of its expansive and punitive nature. Off-balance sheet commitments also are increasing. This will not directly affect things like mortgages, but it will affect warehouse lines of credit, mortgage warehouse facilities, the types of things that independent mortgage banks obtain from banks. And that's because historically, all of those unused lines received a 0% risk weight, recognizing that until the line was drawn upon, there really wasn't a concern. Going forward, these lines will have a 10% charge to them if they are committed and unconditionally cancelable. We have looked through the documentation in our precedent file, and unfortunately, it seems there is a range of market practices, meaning that there are some people who have warehouse lines that are uncommitted, unconditionally cancelable, and some who have warehouse lines that are committed, unconditionally cancelable. And it's not at all clear from just the title of the document if it's in the uncommitted or committed bucket. And so going forward, we think banks are going to put a lot of focus on whether the line is uncommitted and therefore it keeps the historical 0%, or if it is a committed line, in which case it will now have this 10% surcharge to it. And we expect banks also that this will be a further disincentive for larger banks to stay in the warehouse lending line, which we have seen as a number of banks, even in the last year, have exited it because of interest rate and profitability pressures. The next charge and securitizations, we won't go into that in great detail here because I realize that it's more of an SFA issue than an MBA issue. I'll just say that under the proposal, all but the highest rated securitizations would see an increase in their capital requirements. And because this is a change in the regulators' assumptions about their confidence in their own models. And we're going to push back against this, saying that why after all of these years of study are the regulators less confident in their own models? I get maybe being less confident in bank models, but why are the regulators less confident in their own models? So we're going to see a pushback, I think, strongly on this securitization point. Now, the cross default issue is one that I think has not received the amount of coverage it should have in the banking industry. And under the current rules, if a borrower defaults on their loan, then the bank's exposure is increased to 150% punitive risk weight to recognize that the likelihood of recovery on a defaulted loan is less likely than on a performing loan. And under the international standard that's being implemented in Europe by the UK and the European Union, they are proposing to make it a limited cross default, saying that if a commercial borrower defaults and has any other material credit obligations to a bank, all of those material obligations are treated as past due and receive the punitive risk weight. This is again only with respect to commercial obligations. In the US, they have gone a step further and said that if a borrower defaults on any obligation to any creditor, the bank must move all of its exposures into the punitive 150% risk weight. And so you might have a corporate, say a corporate borrower who defaults on a lease for their company car, and that is defaulting to the auto dealer on the lease. And now the bank that is lending for their headquarters building has to move that headquarters building's mortgage into the default bucket because the company defaulted to a completely separate auto dealer. And besides preventing corporates from using selective defaults, it also would require the bank to know who all of its borrowers' other lenders are, which maybe is done in a covenant at the time of origination, but probably isn't done on an ongoing basis. And a number of people, us included, have flagged this as a really unworkable idea of that a bank having universal knowledge of all defaults that a corporate borrower might have. The other item here that has received a lot of press, and I think I know why, but I was a little surprised at is, so right now, GSIBs and Category 2 banks are required to deduct their mortgage servicing assets that exceed 10% of their capital or 15% of their total deductible items. And this is in contrast to the banks in the 100 billion to 700 billion club, which have to deduct that mortgage servicing assets from their capital only if it exceeds 25%. And so this is a recognition that the smaller regional banks can have up to 25% of their capital in mortgage servicing assets without incurring a punitive deduction. The proposal would lower the threshold for all of these banks to the 10% and 15% threshold, meaning if any of these banks had MSAs exceeding 10% of their capital, they would have to deduct that amount from capital, which makes it not economically feasible to hold the MSA. The reason I'm surprised this has received so much coverage is we've done some back of the envelope math, and it appears there are only 2, maybe 3 banking organizations who are affected by this change. And so while it is a punitive change, while it is an unfair change for the regional banks, its economic significance, at least to the current numbers, is not particularly striking. And so I think we know the industry is pushing on this point, and we think it is a reasonable argument to say that you shouldn't have this deduction right after the rules were changed in 2018 as part of the tailoring rule, but also compared to something like the universal cross default, it maybe isn't as economically significant. Lastly, or second to last, 2 more, operational risk. That operational risk is different from credit risk in that operational risk refers to the risk of something bad happening. So bank branch burns down, that's an operational risk. Hacker disables the underwriting software, that's an operational risk. That's in contrast to everything we've been talking about, which is credit risk, borrower defaulting. And under the proposal, all banks in the 100 billion plus bucket would have to hold capital against operational risks. And this capital would be driven by a formula. And the 3 key elements of the formula are a portion of the bank's interest income, all of the bank's revenue from services and other fee-generating businesses, so non-interest items, and then the bank's own historical loss history. Now, that last point is a huge burden on these banks because they will need to identify, quantify, and track all operational loss events of $20,000 or more, which is a fairly low threshold when you think about it in terms of things like employee theft, in terms of things like cyber incidents, in terms of things like employee lawsuits or workplace like HR type issues, that those are all fairly low thresholds if for you to be identifying that an operational loss event has occurred, quantifying it maybe over the life of an EEOC complaint, quantifying it based on final insurance recoveries or other types of recoveries from subrogated parties, and then tracking it over a 10-year history to calculate part of your operational risk capital charge. So that's bad from a keeping track of things perspective. But then from an economic perspective, the inclusion of fee and other services revenue is bad, because for 10 years, the regulators have been telling the banks, look, do less in terms of trading, less in terms of investing, get some steady fee-based businesses that have a reliable revenue stream. And now the regulators are saying, well, all of that revenue will count in the same manner against your operational risk capital charge. And I put here a quote from Jamie Dimon saying, are all revenues equally bad? What person thinks that's a rational thing to do? That clearly some revenues are less risky than others, that credit card interchange revenue, once you scale above a certain level, has a de minimis increase in risk versus something maybe like door-to-door insurance brokerage, where you could argue there's greater risk as you scale up the number of personnel. And so this operational risk capital requirement will affect the mortgage industry in a few ways. It will affect revenue from mortgage servicing assets. So the income that a bank generates from its mortgage servicing assets. It'll affect custody and safekeeping services. So if you're, if one of these banks is a document custody bank for the GSEs, the fees that earned from that activity will be covered. Issuing investment letters of credit is covered. Insurance activities like brokerage and underwriting are covered. And for some banks in the aggregate, this will exceed 20% of risk-weighted assets. So it will be a significant figure. In the last 2 minutes that I have here, I want to touch on market risk, which is the third risk stripe. And this is the risk of prices changing. This will affect all of the 40 banks, plus the smaller banks who had significant trading activity. And they will need to use a different formula to calculate their market risk capital requirements. The requirements will be more prescriptive, the modeling more intensive, and as is relevant to the mortgage sector, there will be a wider range of instruments that count as market risk items. So any type of publicly traded equity that is not expressly excluded, or that has effectively a transfer restriction on it. So anything that doesn't have a transfer restriction, that will be included. Over hedges will be included. Other types of dealing and market making and securities will all be included. And we are expecting this to significantly increase the number of instruments that are subject to the market risk rules, but also in a kind of de minimis way. That we've been talking to some banks that say, oh, we've never had market risk before, but now we're going to have a dozen positions because we have some odd either non-public equities or public equities that are subject to this. We have some odd loan commitments that actually turn out to be a type of risk transfer. And so banks are struggling with how to quantify and model some of these odd market risk positions, which we expect to see to affect pricing of derivatives and also maybe the liquidity and the market price of certain things like public REITs, where the market may not think of it as a publicly traded stock, but it is a publicly traded stock. And so now the bank has to hold more capital against it.
This is an upcoming presentation that's a more detailed 1 hour presentation on the Basel Endgame with a focus on the mortgage market. So we'll pick up and resume our session with Hawker discussing insurance industry investments, insurance investments in the mortgage market at 2. Feel free to type in any questions in the chat box and we'll be with you and resume the presentation very promptly at 2.
Hello, everyone. I'm Hawker Goodmanson. I'm a partner in Mayor Brown's banking and finance practice. I'm a part of a large team in that practice that focuses on financing and other transactions involving residential mortgage loans and other products related to residential mortgage loans and residential real estate. Today, you'll hear from me on a couple of topics. First, I want to spend a few minutes to highlight a trend that we have observed, although not necessarily a new one. This is the increasing entries by insurance companies into the arena of mortgage loan investments. And like I said, it's not a new topic. I think particularly large cap insurance companies have been investing in whole loans for probably decades. But I recently read an interesting paper that proposed that although mortgage investment by those larger insurance has held relatively steady for the last 5 years, such investments by growth-oriented kind of private equity-backed insurance companies has grown over tenfold over the same period, that is the last 5 years. And in our experience, that trend seems to be continuing and spreading into kind of other insurance companies and that have relatively been fairly quiet on the mortgage front. And over the past couple of years, we worked on a cross-practice basis with several insurance companies to design and set up programs for investing in mortgage loans in the most efficient manner possible. For mortgage loans, investments for insurance companies is a proposition that raises a host of complications, particularly in the case of the residential mortgage loans. And this slide here lists a few things to keep in mind when insurance company invest in mortgages. I'm not going to cover them in detail here, but rather use the opportunity to invite everyone who is interested to learn more to attend our upcoming 90-minute webinar, on which a number of us will discuss these and other topics related to insurance company investments and mortgage loans in great detail. Some of the topics we're going to cover is that, first, buying and holding residential mortgage loans is a licensable activity in a number of states. We will discuss some alternative approaches to ameliorating the need to obtain and maintaining state licenses. We're going to secondly talk about the risk-based capital treatment of mortgage loans. Generally speaking, whole loans held on insurance company balance sheets is a relatively attractive capital charge, but the manner in which these the loan are held has a pretty determinative impact on the applied charge. Although that's really the purview of statutory accountants, we will on our call discuss some considerations, and our excellent insurance regulatory lawyers will also talk about other insurance regulatory considerations and certain new developments. Third, we'll discuss different methods of financing the mortgage loans with the federal home loan banks, where a few different approaches are possible, some of which may not be consistent with some of the other goals that we're trying to achieve. I know later today, I think you'll hear from Andrew on some potential federal home loan bank reforms, but our webinar will provide some practical points on financing arrangements under the existing regime. We'll talk about also asset managers, working with asset manager, provide some tips on best practices in setting up acquisition programs and a number of other topics. So I'm not going to get into that in any more detail other than to invite you to join the webinar on October 12th. If you need an invite to the webinar and are interested to attend, you can use this code at the bottom of the slide here, or ask one of us to send you one, and we'll be happy to do so. I'm going to spend the bulk of my time, however, to talk about investments in MSRs, which have been in great demand during the past few years, particularly as interest rates have risen in the past couple of years. However, there are several impediments to MSR investments. These arise in large parts from the very nature of MSR. So let's start by refreshing a little on what is an MSR. From a legal perspective, an MSR that is separate from the related mortgage loan refers to the right to service such mortgage loan pursuant to a contract with the person who owns the loans, and importantly, to receive the servicing fee associated with that servicing. In other words, the terms of that right are created under the contract with the applicable agency, or in the private label case, the applicable trust. The right is conditioned, importantly, upon the performance of the servicer's obligations to service the loan, either directly or through a subsidiary. If the servicer fails or is unable to service the mortgage, it will likely be terminated as servicer and the MSR vanishes. So the biggest impediments to MSR ownerships are naturally that one must be able to service the loan, which means, among other things, that one must be licensed by various state authorities that impose licensing requirements upon people engaged in servicing activity. And one must be approved by a servicer by the applicable agency in order to, enter into and perform under the servicing contract in the first place. And this slide here lists a number of ways in which one can invest in MSRs, from the relatively easy one of buying a stock in a publicly traded servicer, which a lot of you can do probably before I stop talking to you this afternoon. To some of the more time-consuming and resource-consuming processes of starting a new servicer, obtaining state licenses, and obtaining Fannie, Freddie, or Ginnie tickets, which can take a couple of years. Of course, that's an exercise that may well be worthwhile, and there may be certain shortcuts possible, which our licensing and regulatory team would be happy to discuss, but are outside the scope of this presentation. Other avenues of MSR investments include buying an existing licensed and ticketed servicer, and Brian talked earlier about some of the things to keep in mind in that exercise, which can be quite a bit more involved than it sounds that it should be, because of state and agency change of control approval requirements and the like. It may be simpler to buy excess servicing spread from an existing servicer, which effectively represents a right to receive a portion of the servicing income for the pool of MSRs. These types of trades have been around for a long time, although may become a bit more challenging in the future, as we'll discuss in a few minutes. Fannie and Freddie require that servicer obtain their consents for such arrangements, and will impose various conditions, including that the servicer must retain at least 12.5 basis points of the servicing income. This requirement leaves it effectively to the servicer to fund the remaining 12.5 basis points. To do so, some turn to what I call alternative arrangements, often documented as reference spread or tracking stock. The reference spread, or RESPA, is typically an unsecured payment obligation of the servicer's parents, or sometimes the servicer itself. It does not represent an interest in the MSR, but is rather an obligation by the parent or the servicer to pay amounts to the investor that track the economics of the remainder of the MSR once the true excess or TESPA has been sold pursuant to the transaction that the agency consents. This can also be accomplished through tracking stock in the servicer, a credit linked note, or a similar arrangement that just kind of effectively transfers economics. To round out the list of MSR investments available, MSR securitizations have been around for a number of years, and their setup can be pretty complicated, but usually the servicer will repo the excess MSRs to the securitization issuer, who issues VFN notes and often term notes that are secured by the issuer's interest in the repurchase agreement in the excess. The servicer will then pledge the MSR to secure its obligations under the repo. I'm going to talk a little bit about stripped coupon certificates in a minute, which are effectively bonds backed by the excess servicing and guaranteed by Fannie or Freddie. MSR funds are on the list. There's been a bit of an emergence of MSR funds lately, so private equity funds focused on investing in MSRs, usually through one or more of the methods that I've just discussed. And we worked with a number of those in navigating these issues that are created by any of these methods. Although additional issues arise in the fund context, particularly in instances where there's affiliation between the fund manager and one or more servicers. But that's also probably outside the scope of our talk today. But to wrap it up on this slide, one could always invest in one of those MSR funds and thereby effectively outsourcing the structuring work to the fund manager. And so we're going to switch gears slightly and talk a little bit about the kind of, I guess maybe recent is not a right word anymore, but the Ginnie Mae RBC or risk-based capital requirements. As everyone probably knows, Ginnie Mae announced new risk-based capital requirements for Ginnie servicers in August 2022, which is in addition to other financial requirements, including minimum liquidity and minimum net worth. Originally, these risk-based capital requirements were supposed to go into effect at the end of this year, but following industry feedback, the effective date was pushed back to the end of 2024. Basically, the rule requires servicers to maintain minimum risk-based capital requirements or ratios of at least 6%. I'm mentioning this here because this development can be pretty relevant to many of the investment strategies that I mentioned earlier. And this is because the capital ratio calculation is highly negatively impacted by MSR financing or MSR related liabilities on the servicer's balance sheet. The formula for calculating the ratio is on this slide: adjusted net worth minus excess mortgage servicing rights divided by total risk-based assets. The most punitive feature when it comes to MSR liabilities is the subtraction of excess mortgage servicing rights from the numerator. Excess MSRs are defined as MSRs in excess of the servicer's adjusted net worth. So if a servicer has the world's simplest balance sheet of $100 million, consisting only of MSRs, with 60 million of liabilities, the adjusted net worth would be 40 million. The excess MSR would be 100 million less than 40 million, or 60 million. So the numerator in this example will be negative 20 million. In addition, the gross MSR, which in this example would be 40 million, would be subject to a 250% risk weight for purposes of calculating the denominator. And that, by the way, is the highest possible capital charge. The second highest is 100% for other assets. And then, of course, the liabilities are also subtracted from the assets in order to calculate the adjusted net. I guess I'll acknowledge here that I did not put these calculations on the slide, which is because I'm a lawyer and I didn't want anybody auditing my math. But it's pretty obvious in the context of thinking through the various instruments that I just discussed, that to the extent that they appear on the servicer's balance sheet as a liability, they can have a pretty significant impact on the risk-based capital calculations, particularly for less diversified balance sheets. For example, many, if not most, servicers treat the standard sale of excess servicing strip not as true sale for GAAP purposes, even though a legal true sale opinion is often available, but is a liability. And I understand, and I've heard from a number of people in the industry that Ginny has indicated that they may be open to provide relief from the calculation for excess servicing transactions that satisfy certain conditions, which are expected to be kind of publicized soon, but have not materialized as of yet. Of course, these requirements will also affect servicers' ability to obtain financing, generally speaking, and it's clear that once these rules go into effect, that at the servicer's parent company level, such as high yield issuances or senior secured term loans, that do not result in liabilities on the servicer's balance sheet, but stay on the parent's balance sheet, will become relatively more attractive for Ginny servicers compared to traditional kind of asset-backed funding at the servicer level. Another kind of Ginny-related topic I wanted to touch on briefly is the funding of Ginny advances, and I think that's the next slide. Ginny. So I think it's pretty common knowledge. Ginny advances have traditionally been tricky to fund or finance in past years, and it's only been a couple of years since Ginny would even allow a mention of them in their acknowledgement agreements. This difficulty stems in large part from the way in which the Ginny securitization program is structured, because unlike Fannie and Freddie securitizations, where advances are generally considered separate from the MSRs and represent effectively a right to be reimbursed by Fannie and Freddie for the related advance, in the Ginny program, advances really represent the right of the servicer to retain certain proceeds of the FHA or the government insurance proceeds when once received by the servicer, and therefore are kind of pretty closely tied to the MSR itself. And this has obviously been an issue for a long time, but I will mention it here because there seems to be some momentum in the industry to propose some potential solutions. And I think nothing has materialized yet, but it will certainly be a topic that both Mayor Brown and the MBA have been actively involved in, and no doubt will report any significant developments as they occur. Next slide, please. The last topic I wanted to talk about is also maybe not a new development, but a reemergence of what I'll call the excess yield securitizations. And these are transactions that are not new, but have been largely dormant for the past decade or so. In short, the way that these transactions work is that the servicer will sell some or all of its excess yield, which in this case represents a portion of the servicing fee in excess of 25 basis points. They'll sell the excess yield to the applicable GSE in exchange for Fannie or Freddie guaranteed bonds that effectively pass through the payments on such excess yield to the bondholders. the servicer will usually sell the bond to a third party, typically an investment bank or even the GSE itself. And my understanding is that unlike traditional excess servicing sales, accountants have been treating these trades as true sales for GAAP purposes. One consideration that servicers that are considering these arrangements should keep in mind is that the excess yield arrangement, which includes a ongoing advancing obligation with respect to the sold excess yield, will, upon the sale of the MSR, transfer to the new servicer. And so some, including some MSR lenders, have raised concerns that the execution of one of these transactions might reduce the liquidity of the MSR. It seems that those transactions, though, have become, pretty common. We've seen MSR trades close with these requirements attached to them without really much of an additional effort, and those types of concerns will likely recede as we continue to see these trade occur. And with that, I think I'll close on MSRs, but please let us know if you have any questions or would like to discuss any of these topics further.
Okay, I'm gonna go ahead and start here and cover two quick topics that aren't directly going to impact REIT businesses, but are ones that you should be very much aware of because they're going to potentially could impact the larger mortgage, particularly the mortgage ecosystem. So the first one is the ongoing review of the Federal Home Loan Bank system that the Federal Finance Agency has undertaken. Can you go to the next slide? Terrific. So FHFA Director Sandra Thompson has initiated a review of the home loan bank system kind of based on its almost now 100-year history. The review is comprehensive in scope, and as you can see, she has solicited comment on very broad topics relating to just every kind of conceivable nature of the home loan banks, including their mission and what the purpose of the home loan banks should be. The comment period has now closed, and we're actually expecting the recommendation as soon as the end of this month. What is likely to be contained in the recommendations that FHFA comes out with? Well, one particular focus has been on the amount of funding that the home loan banks provide for affordable housing and other community development projects. It's very much expected that that commitment will be increased as part of this. The other areas that are been particular focus are on the role of the home loan banks in lending to banks during distressed periods. The recent case of failure of Silicon Valley and Signature Bank generated a fair amount of discussion about the role of federal home loan banks as lenders of last resort. There are some former Federal Reserve officials who have raised some particular issues there. That said, those issues, having looked at them pretty extensively, I'm not so sure that there's really much there, but you could start to see some changes to how the home loan banks potentially take collateral in times of distress. There's also been a fair amount of activity around membership in the home loan banks, who should be a member and at what levels. There are certainly some groups that want to limit the home loan bank membership to smaller entities and limit the role of the larger banks. I think that is probably very unlikely given the interest in continuing to have a robust affordable housing commitment from the home loan banks, but we'll have to wait and see. I don't really see membership opening up to captives once again. I think that ship has sailed. The issue has been more about whether or not the home loan banks could do more about supporting community development organizations and small businesses. But given the role of the home loan banks in supporting the mortgage finance system, any changes here can certainly have a larger impact on the mortgage market. So stay tuned. Moving to the next slide. The other issue I want to just flag for attention is some developments at the Financial Stability Oversight Council, also known as the FSOC. This is an organization that's somewhat forgotten often, that was created during under the Dodd-Frank Act. It's a council composed of the heads of all the agencies, financial regulatory agencies. They're required to come together to examine the financial system for any potential systemic risks that their individual agency may not be specifically focused on, because it's only focused on their particular regulated entities, and get the regulators to look at the system as a whole. The FSOC has the ability to make recommendations to financial regulators for changes in prudential regulation, but their really big power is that they have the ability to designate non-bank financial companies for enhanced supervision by the Federal Reserve. As you may remember, several years ago, the FSOC used this authority and designated several insurance companies for enhanced supervision. However, there was a lawsuit. MetLife sued the FSOC over its designation and then won in district court. As a result of that case and changes in administration and policy, the FSOC is now no longer has any companies that are designated. Secretary Yellen, however, believes that the FSOC should be much more vigorous in designating more companies. She has initiated a review of the process and guidance by which they designate companies that is underway. In fact, on Friday, they have a meeting which they are scheduled to discuss their revisions to their designation guidance. So it is very possible we see a shift in FSOC and moving to start designating companies sometime over the next year, or at least beginning a more thorough review of companies for potential designation. The types of companies that the FSOC has been focused on, at least in its reports, are large hedge funds, large asset managers, and to a lesser extent, kind of large non-bank mortgage companies. In my view, this is a process that will likely take, even if the FSOC wants to move forward with designations, that's going to take some time, given the legal potential challenges here, and just the process alone of building the record that would support a designation. That this will likely take well more than a year from now. However, it is something that over time could have an impact on the overall market, particularly if the FSOC starts to designate entities that are either non-bank mortgage companies or that play a significant role in the financing of mortgages because they're large, say, asset managers. Because the rules that these designated companies would be subject to would be enhanced capital and liquidity standards, so it'd be very likely substantially higher prudential requirements that they're subject to now. So with that, with those two overviews, I think I will pass it on to our next speaker.
Great. Thank you, Andrew. I hope everyone is well. I have the pleasure of being the final speaker, so I have 10 minutes to talk about home equity lines of credit and home equity investments. So let's start off right now. So with the obviously decrease in purchase money mortgage loans, as well as the increase in equity at the residential level, we have seen a significant increase in interest for home equity related products. And those include HELOCs, which we are going to talk about today. It also includes home equity loans, closed-end loans, and home equity investment products, which have proliferated in the marketplace. And we spent an enormous amount of time on regulatory, finance, and capital markets related issues involving these different products. So let's talk a little bit about HELOCs today and some significant regulatory challenges and issues that folks should consider when they are determining whether or not to invest in either to originate or invest in home equity lines of credit. So what is a home equity line of credit? Well, obviously, most people know what a HELOC is, obviously a revolver that allows you to repay a portion of the proceeds and draw again. But there's a specific definition in TILA, which is important for purposes of determining whether or not a particular transaction actually qualifies for a HELOC, which then dictates the requirements that are applicable. And I'll talk about why in a moment. But a HELOC generally is a transaction where the creditor reasonably contemplates repeated transactions. There's a finance charge from time to time, and the amount of credit that is available will replenish while an amount is outstanding. Next slide, please. So, as I said, there are two key transactions, two key issues. One is the existence of a plan and repeated transactions. And the reason this is important, talk about a bit again later, is that to the extent that a transaction qualifies as a home equity line of credit, it is not subject to the ability to repay requirements that are contained in the Federal Truth in Lending Act. And that ends up being incredibly important for purposes of providing credit in a very quick fashion and not actually having to do the third-party verification related activities, although there's still ATR UDAP related requirements. So the creditor has to reasonably contemplate that the borrower will reuse the plan and that it must be usable from time to time. So the focus is on both how the creditor has designed the plan and whether the borrower actually engages in repeated transactions over time. Next slide, please. So as I said before, different regulatory requirements, most importantly, the ATR requirements. Next slide, please. So the ATR requirements require a creditor to verify ability to repay, and they are incredibly prescriptive. So a creditor is also prohibited from structuring a transaction as an open-end loan, a HELOC, in order to evade those ATR and other related requirements. So we see lots of products in the market, lots of new products where instead of your typical 10-year draw period, 20-year repayment period, that instead consumers and borrowers are required to draw either 100% or close to 100%. The draw periods are significantly less than your typical 10-year draw period. And the justification for that is that you get better capital markets execution. But as I said, it really does have a material effect on the applicable legal requirements. And if you're wrong and ATR is applicable, then of course there are material and significant regulatory penalties that arise. There also are ability of the borrower to raise an action to collect in defense to an action to collect the debt, an ATR violation, and enhanced damages that arise. Next slide, please. So what are some of the other considerations in addition to ATR? Obviously, lender licensing. So unlike a typical closed-end loan, there are additional draws. So if the transaction is, once it's originated and or sold and serviced, someone has to be licensed and or otherwise exempt from licensing requirements in order to fund those additional draws. So as Hocker talked about earlier when he was talking about MSRs, similar issues here, at least from a state licensing perspective. There are various ways to structure in order to limit or avoid licensing obligations, but incredibly important to consider. Next slide, please. There are some other important issues to think about. The first one is that HELOCs are not negotiable instruments. So there isn't any holder in due course protection under the UCC. That being said, there may be common law related protections that are applicable, but if there is no holder in due course, that means that a purchaser is a borrower is able to raise as a defense to an action to collect the debt any violations of law that occurred prior to the sale, but again, there may be common law requirements. A second important regulatory consideration is that unlike in a closed-end loan, either a HELO, a home equity loan, or a purchase money transaction, there is a requirement in TILA to disclose all fees that are incurred in connection with the plan. So effectively, subject to certain limitations, you actually have to disclose not only the origination related fees, but also most servicing fees. So you do that through an addendum or otherwise, although sometimes people don't understand that. There also are requirements related to application of payments. There also are material restrictions and limitations related to changes in terms. So, for example, there are some products out there that include credit card access devices. Those access devices cannot be eliminated unless the borrower expressly agrees to do so in writing, or it's a change that is clearly beneficial to the borrower, which would be hard to imagine, which is important because not everyone has the authority to issue an access device. So, for example, branded cards, Visa, MasterCard, you have to be a bank, which means that the account would need to remain with the bank, even though the receivable is sold, which is more similar to a credit card, but not a typical HELOC. In addition, there are material restrictions on change in terms, most importantly, suspending or freezing the line of credit, which means there's line management issues. It's not as easy as a credit card where you could effectively turn off credit at any time. There are only limited circumstances when that can occur. Basically, a material change in the financial circumstances of the debtor, which leads to a reasonable belief that a consumer is unable or a debtor to repay the obligation, or a material decline in the value of the property securing the loan, which the agencies have provided significant guidance on, and people don't really understand that. A couple other regulatory considerations to consider, next slide please, are the usury related issues. So unlike for a first lien loan, second lien loans do not gain the benefit of first lien usury preemption under the Depository Institutions Deregulation Monetary Control Act. So banks may still have the authority to export interest from the state in which they're located, but non-bank mortgage companies need to comply with usury restrictions, which they generally don't have to in most states for first lien loans. Additionally, there's no uniform documents. So unlike for residential, first lien residential mortgage loans, for seconds as well, in some cases you don't have uniform documents, Fannie Freddie. So the actual documents are vary significantly, both in content as well as quality. So these are some of the things to consider for, excuse me, HELOCs. There's a common theme for other home equity products, which I mentioned at the beginning, which is recharacterization. Is it what it purports to be? Is it a HELOC or is it a closed-end loan? And for some of the newer products, that's a significant material issue to address, just like for a home equity investment product. Is it a investment, an option contract, for example, or is it a loan? So I hope that is helpful, just to provide a little bit of detail. And then finally, I'd like to thank the MBA for allowing us to participate and present. Thank you, obviously, to all the participants for listening to us. We've included resources that are available to folks if they would like to sign up for any of our free issuances. If anybody has any questions, obviously, of any of the content, please feel free to reach out to any of the Mayor Brown participants. So again, I'm right at 3 o'clock. So I will thank the MBA. I'll turn it back over to Mike or anyone else if you guys have any sort of closing remarks or things that you'd like to add.
Great. Thank you, Steve, and the whole team at Mayor Brown. A really informative set of presentations. So I'll just close things out on behalf of Sasha Hewlett and myself at MBA. Sasha heads up our secondary and capital markets activities. So I know we both have thoroughly enjoyed this, and looking at the participant attendance all throughout, I think they have as well. So thank you all for the preparation and the information, and hope we can do this again. Thank you very much.
Thanks again, Sasha and Mike. We really appreciate it.